Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
That's right. Oh, man. I'm so tired. We've been moving our office, finally. The computers that I ordered last year and that were supposed to be here in September finally got here. It's March. It's actually halfway through March. And so for the next few days, next week, we'll be moving a little bit. By the end of this week, we will be in our new office space. Hooray! So if you have called and it's taken me a day or two to get back to you, that's why. It's very difficult to move all that stuff, and hopefully, obviously it wasn't planned this way. This is our busiest time of year, but so just so you know, by the end of this week, we should be all done, good, ready to go, and we got a lot of good stuff coming. One of the reasons I wanted to move is I put a big screen, a big monitor up. So if you want to come in, we can put all my stuff up on the big screen so that we both can see it and take a good look at it and get to know that really well. We're going to be using the new tools that we've gotten over the past couple of years, which I think are going to be incredibly helpful, especially going forward. Very important now. Extremely important, as something's been happening that happened in the late 90s, happened in 2003 up through 2007. You had these time periods where certain sectors of the market did very, very, very well, and it made people think that all stocks were doing well when in fact it was one or two sectors. And then when those sectors came crashing down, everybody was disappointed. So that's going on again. We're not at the same levels that we were then on a valuation basis. And at the next workshop thing I'm going to do, we're going to talk about that. I'm going to show you what I mean by that. And I have been working hard, incidentally, on trying to get the little booklet out that I talked about at the last seminar. So you guys hang on out there. Please try to be patient with me. And I'm going to be talking about that topic again at the next seminar. And it's basically learning basic portfolio management skills. Now, why would you want to do that? And that's a lot of people are asking, why would I want to do that? There are all these mutual funds out there. Why do I need to know that? Well, a few reasons. If you get that wrong, if you don't know what the fund managers are doing, you're going to go with the funds that have taken the most risk recently. That's the natural reaction when people are searching for the investments that they want to invest in without knowing how the returns are made. And so what they end up doing is that they end up looking for those things that have just gone up the most, and they don't even realize it. They don't know that. And they'll argue about that. They'll say, no, I looked at the 3-year and the 5-year, and I looked at the beta and the alpha. And hey, let me tell you something. If it were that easy, it would already be done. Sorry about that. Just disconnected my headset for a second there. So it's just not that easy. You need to know a little bit more about that. And that's why you learn how to do it, so that you can recognize others that are doing it the right way. And the right way, by the way, is not the easy way. Right way is not the easy way. So it can be simple, but it's not easy. Big difference. That'll all mean more after the workshops. And we're going to kind of make this a core, because realistically what we're doing when you're learning how to manage a portfolio is you're learning basic risk management skills. That's what you're doing. You're learning how to manage the risk that you're taking. Now today in America, in Japan, and a lot of European countries, because interest rates are so low, you're being forced to invest in other asset classes like stocks and bonds. And you really, really need to learn about that before you get started. It'll help you avoid running out of money during retirement, knowing that. It'll help you pick a financial advisor, because the vast majority of people, when they get through these courses, they look at it and they go, oh, yeah, that's a lot like work. And it is. It's a lot like work. If you like it, it's not like work. But if you don't like it, it's a lot like work. So instead of avoiding it or shunning it or not paying much attention to it, if you get with an instructor that can cut your learning curve down, make it somewhat enjoyable, and that's the goal with these programs, to cut the learning curve down and make it enjoyable. So then you're able to go out and better evaluate financial advisors. So let me say that again. If you learn the process, you can go out and evaluate financial advisors much, much better. And you will know a lot of things that they don't. I know. A lot of them are my friends. And they're nice people. They're very well-meaning. And a lot of them do a good job. But you won't be able to tell the difference between the ones that are just nice people and the ones that know what they're doing unless you know this. And here's a classic example. The easiest thing to sell right now is large cap growth. Why? Because it was up about 30% in 2017. It smoked everything. Okay. And it's outperformed in about 3 of the last 5 years. The worst performing category was small cap value. It was up only 8%. So if you're small cap, there's a pretty good chance that you got beat by large cap. Now, if you go back over the last 100 years, small cap has outperformed large cap by a wide margin. Now, that makes sense that should happen, because Microsoft, when it was only a $4 billion company, that was pretty big by those standards. But today, it's billions upon billions. In fact, I should look that up. Hang on a second. I'll do that. How many billions is Microsoft worth today? 728. Okay. So if you waited for Microsoft to get big enough to be in the top 500 companies, you missed that move from under $1 billion up to billions upon billions. So in the long run, like the super long run, that's what we're looking for. We're looking for some exposure into the future Microsofts when they're small. And yeah, are they going to underperform from time to time? Yes, they are. But you can't predict when they're going to outperform. In the long run, when I'm talking over a 10 or 20-year time period, the returns on small cap stocks has a tendency to be significantly higher. So if you were doing the prudent thing, the smart thing, you'd be taking some of the money out of the large cap growth, which Microsoft is a part of, again, by the way. And Microsoft is no longer an inexpensive stock. It was inexpensive for about 8 or 9 years. I'm not kidding. It was inexpensive for 8 or 9 years. I got so tired of talking about it, and I quit. Okay? Because people had watched the stock go up in the late 90s. It peaked out around $56, somewhere around that level. And then in 2009, it was selling at 18. Okay? When that stock came down under like around $24, that was its fair market value, $24. Fair market value. And it didn't get to that level until 2009. Even after the crash, it was not undervalued. It was so overpriced. It was so overvalued that after the crash of 2000 through 2003, it was still not undervalued. So then you go fast forward in 2009, it is undervalued big time. Nobody wants it. Nobody wants it. Everybody thinks you're crazy for investing in that stock. It got down to $18. Well, yesterday it closed at $94.60. How you like me now? That's all I'm saying. It doesn't make sense in the short run. You better have a long-term hot time horizon. You have to understand these things, but only if you want to avoid running out of money during retirement. If you don't care about that, or maybe you're just super rich, maybe you own a business that generates a ton of cash. That's awesome. That's great. The vast majority of us are going to have to learn how to identify good stock portfolios. Understand that, yes, they can go down and stay sideways for a long time period. You're not always going to beat the S&P 500, especially when a handful of stocks makes up more than half the returns, because you'd have to be incredible. That's a lot. That's risky. When a handful of your stocks make up half of your returns, that's a lot of risk. You've got to recognize that. Why do you need to recognize that? So that you can avoid it. And it's kind of like what was that movie? My mind is going on me. I was talking about movies at the Starbucks this morning on the way in there. The Karate Kid. Why do you learn karate? So that you can defend yourself, and so that you don't have to fight. Actually, that's what karate is for. They learn so that they don't have to, because then they can defend themselves pretty easily. Same thing with the market. You need to learn how to defend yourself financially, so that you won't have to. You can avoid a lot of the problems just by knowing this kind of stuff. And I gotta give hats off to Ed Flash Ferentz. That guy, he has the patience of Job. Now, he was not that way when he first met me. He was the total opposite of that. And dude has learned and changed, and he's done very well. So we were talking about his stock. I won't mention it, but man, boy, talk about a turnaround. And so anyway, that's why we do this kind of stuff, so that you can basically protect yourself, find an advisor that you can work with, try to figure out how much risk you're taking, try to figure out how much risk you need to take, and try to get an idea of how much risk that you're comfortable taking. See, there are 3 levels of risk. There's the risk that you're taking, there's the risk that you need to take, and then there's the risk that you're comfortable taking. Hopefully, all 3 of those numbers are the same. That would be the A+ job. I'm taking the exact amount of risk that I need to take. It's suitable for me. I'm comfortable, and I'm comfortable doing it. So the risk that I'm taking is the same as the risk I need and that I'm comfortable with. That would be the A+ job. And we've got a phenomenal tool to help us identify that now. And I've been talking about a few weeks now. But it's a software package. It's a package that I would have developed myself if I had a few extra $1 million laying around, and didn't mind taking several years to do it. Well, it's here now, and now I can subscribe to it. And these guys did what I don't know, any of you that's been to my seminars in the past and you saw the hypothetical illustrations we do, the ones I called Murphy. Okay, well, these guys did the Murphy on steroids. That illustration that I used, these guys have really taken that to the next level, and I'm so happy because I don't have to do it. And I did put together painstakingly, gathering the data using spreadsheets. That is brutal, by the way. Something that was very similar to that. I don't know if some of you recall, but I showed the peak to trough declines of various portfolios a long time ago. Well, you have to update that by hand, by the way. Now these guys are doing it, and they do a better job. You can stress test your portfolio. You can put your portfolio into this program, and it'll show you the kind of risk you're taking. It'll show you the probabilities of you running out of money during retirement. That is pretty sweet, and it's simple. Well, it's relatively simple for me. So if you're out there and you're listening to this, what is he talking about? How much risk am I taking? Will I run out of money during retirement? Will I make enough to be able to retire? It answers all those questions, and it's relatively simple. There's a 5-question questionnaire you can answer. If you struggle with it, you can always set up an appointment, come in the office, especially the new office. That's why I set it up. I set up a big screen, make it very comfortable. You can come in there, sit down, relax, get a cup of coffee, and we'll talk, and I'll show you. And you can stay there until you get it. It doesn't. I'm going to end up sleeping there most nights, I think. But anyway, it's pretty cool. I'm really excited about it. It's about time, actually. They should have had this tool 20 years ago. It is about time. And so I'm really excited about that. And if you want to learn more about any of this stuff, you can just go to my website, bullingtoncapital.com. You can sign up for a seminar there. You can sign up for a meeting. And again, I apologize. I know I got a couple people this week that I haven't been able to get back to because we were moving. And my apologies. I will absolutely make it a point to contact you before Monday. So either sometime later today or tomorrow, I will be in touch with you. And thanks for all those people that came out to the workshop. I did get I ordered the Chromebook that I was supposed to give away at the workshop. I've got the cards, so I'm just going to draw from the cards. It actually hadn't come in when the seminar was there, and I forgot. Nobody reminded me to do the drawing there too. That's kind of funny. But anyway, I'm going to do the drawing, and I will let you know next weekend who got the Chromebook, and they're really cool. It's still in the box, by the way. I didn't even open it. So Chromebooks are like a laptop that use the Google Chrome operating system. It's a laptop made by Google or with Google software. I'm getting so caught up in the Google stuff. By the way, when you have this, you just got to be careful. But Google is one of the safer methods. The Chrome works really well. I don't know. I got this Chromecast too. It's from Google. You plug it into your television, and you can broadcast from your cell. You get 5 or 6 different accounts. It's $35 a month. I sound like a Google commercial here. Yeah, it's just really cool. So I'll be able to take whatever's on my laptop, put it up on a big screen so you can see it really well. We did get 34-inch curved monitors for our new office, so that when people come in, I can show you the stock stuff. It's a lot easier to see. It kind of pops out at you. I really like that a lot too. I would recommend that to everybody. Get as big of a screen as you can comfortably afford. Affordability is both on size. You may not have that much space, but and cost. So, because the larger your screen is, the easier it is to see a lot of these things, and they just hit home a little bit more. That's one of the reasons I really like movies. Yeah, because you go to the movie and you're sitting in front of the screen. That's all you're looking at. You're absorbed. So the bigger your screen, the quicker. And you know what? In fact, that would be a really good scientific study. I would bet big money that if you took if they did a scientific study on the speed with which kids or people in general learn things with, it would be they would find out that the bigger screens cause them to learn faster. I would bet big money on that. Well, maybe not big money. Anyway, I hear the music. That means I got to take a real quick commercial break. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned. And we're back. Hey, you can call us 216-901-0945, 216-901-0945. If you have any questions, I'll be glad to try to address that. But, we started off the first segment talking a little bit about learning how to basic portfolio management skills. And realistically, you're probably not going to do this full time for a living, but I feel like it's really important that you understand how to do it. Okay? So even if you never planned on driving a car in America, it's probably a good idea to learn how anyway, just in case you get stuck someplace. Well, actually, I take that back. 10 years from now, you'll just get an Uber and it'll come up without a driver and you'll just take off. But so it might not be as important. So that's a pretty crappy analogy now that I think about it. But you really need to know this just so that you can tell the difference between a financial advisor who knows what they're doing and a financial advisor who just passed the tests. We all know people, and they're good people, and very well-meaning, who have great memories, but have a hard time figuring things out. If you've got a great memory, you can pass the test. You just memorize the answers. If you can figure things out, the more the better. I'll give an example. I'm looking at, I get some research from some huge firms, and I'm looking at some of the stuff that they're doing. And I call up to find out who the portfolio manager of one fund is, because I'm betting that this guy is in his 30s. And I know it's a guy because I saw his name on the prospectus. So, yeah, I've called up. How old is the portfolio manager, blah, 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 blah? I'm not going to name his name or anything because that wouldn't be good. But anyway, and it's not a big deal. It's not like he's not going to lose all people's money or anything like that. It's just that they're doing something that is not doable, and they're doing it anyway. When I say it's not doable, what I mean is they're not going to get the effect that they're looking for. And only a portfolio manager in their mid-30s wouldn't know that. If you were in your mid-40s, you would know why that doesn't work, and you would know not to do that. And there are certain things that you just can't do, especially when you get to a size, of the firm that a firm like that is. I mean, you're talking about $6 trillion, I think they manage now. So there's a certain thing. It's called liquidity. Liquidity makes it very difficult to exercise a lot of strategies if you're a large investor. And you see that's the kind of thing I'm talking about. We had a guy come in, or there was a guy that was asking questions about a BND. That's the Aggregate Bond Index. And I'm like, yeah, that's okay. But if you look to 2008, the share price is the same price it was back then. Yeah, you've probably made 2 or 3% a year if you reinvested all your dividends. But the price on the fund that mirrors that index was $85 a share back in 2012, and it's only $79 now. And it's one of the things we talk about in our workshop. And the guy that was asking the question, nice guy, very intelligent question, absolutely. Not old enough to have seen what I'm talking about. That's what I'm talking about. In theory, things work really well on paper. Then you put them into practice. That's why true knowledge is the combination of information and experience. That's what knowledge and wisdom is. It's the combination of information and experience. So you can, your financial advisors that have been around the block a few times, they can really help. There are a lot of things that you probably want to avoid, if at all possible. And it's difficult. It's difficult even when you know what you're doing. That's why it's really important that you try to do the best you can to try and learn as much as you can about this. It's really it's really not that complicated if you refuse to let it be. I'm not going to tell you it's going to be easy because there's a lot of language that you have to learn. Earnings per share is one of them. That's one I've been struggling with over the last week because there's so many renditions out there, and I want to make it easy. That's the challenge. I don't have First Amendment rights. I'm not sure how many people realize that. When you have securities licenses and when you've held as many securities licenses as I have, then you know what you can and can't say. The SEC and FINRA regulates how we're supposed to communicate with the public. They literally regulate how we're supposed to communicate with the public. Now, somebody that's outside of the industry looks at that and says, wait a minute, you're still an American. You have First Amendment rights. No, you don't. If you get the license, you've already agreed that to hold this license, to operate in this business, I will refuse to say certain things. And you have to stick to that because then they'll take your license away. So I don't know how many of you knew that. Most of the people that work at financial institutions and the ones that are trying to stay within the rules, it makes it incredibly difficult just on a basic educational level because you have to be so careful about what you're talking about. And anyway, and I'll give you an example. Somebody comes and say, well, how'd that portfolio do? You really should probably steer clear of answering that. Because if you answer that question, then you have to make available a lot of other recommendations that you may or may not have made, or the disclaimer that you're going to have to add to that's going to take up the rest of your show. So there are a lot of things that you really you should try to avoid. And by the way, past performance is one of them. They really are sticky about that and how you mention that stuff. So you got to be very careful. Now, when you're sitting in an office setting and it's a one-on-one meeting, then if your advisor is licensed properly, they can print out this stuff and hand it to you. But you've actually got to go in there for a one-on-one meeting. And then you're going to get stuff that's approved for distribution, but it's only approved for distribution for somebody who's a client or potential client. You can't just print it out and send it out to the masses. And I know that upsets an awful lot of people because they don't understand that rule. That's what we have to live by the way. How'd you like to have to deal with that? Nope, can't say that. In fact, I used to get so frustrated with our compliance officers at the other firms I'd worked for. I'd be like, I don't care if you have to tell me, don't invest with me because you're going to lose money. Just put it out there and I'll run. So, and in fact, a lot of them, that's exactly what they want you to say. I mean, it's some of these regulators, they need to regulate the regulators. That's what needs to be regulated. Anyway, I'm looking at kind of getting off subject here. Learning the basic portfolio management skills is not that difficult. It really depends on the instructor, and I think I'm going to try to make it as simple as possible. I'm always available. In fact, I got a question regarding MLPs, Master Limited Partnerships, and I actually invest in a portfolio of them that is involved in midstream. Those are pipeline companies. Those are the distribution. A few of them have some other facilities like the exploration. Those are the drillers. Then you've got the processors. Then you've got the midstream or the pipelines. Some of them have a little bit of all of them. And there was a ruling that came down that was interpreted as really negative, sent the whole industry down 4 or 5% in a day, which is a lot in a day. I'm just looking at it going, really? I mean, this thing is still off of its all-time highs by a lot. Okay, it's off of its all-time highs by a lot. Now, if I hadn't been investing all along and reinvesting the dividends, I'd be really negative in that position. Okay, and then this comes out, and the sentiment couldn't be worse. I mean, the institutions, they just hate it right now. Investors, individual investors, they just hate it. So, which actually helps me out a lot. See, the contrarian in me goes, the thing that somebody really hates, when they really just can't stand it and they're going to start throwing in the towel, that may be where you want to start looking. So I did send him a link. The guy that actually called it or emailed me and asked about it, I sent him a link, and he asked if I would talk about it. And sure, my feelings are basically complete agreement with what the article said. By the way, the article came from a company, it's a research company that follows that industry pretty closely. Is it a negative? It's a slight negative for some companies, but a slight negative. It's not a huge negative. It's not a huge negative. It's not going to stop their sales. They're going to pay a slightly different tax rate. Some of them will pay a slightly different tax rate, not all of them. Certainly not enough to send the entire industry down 4 or 5% in a day. That was an overreaction. And, that's par for the course now. I mean, it's just been like that. Really out of favor. And the thing that is kind of interesting about this is how do people really think that all this natural gas that they've been finding, that all this, the crude oil that they've been finding through the fracking, how do they think that's going to get to where it needs to go? I mean, realistically. Incidentally, you know who one of the biggest investors in pipelines are? Is Warren Buffett. That's right. Would Warren Buffett be buying? He's the largest pipeline. One of the companies that he owns is the largest owner of pipelines in the country. So if he's investing in it, I'll stick it out. And the dividend yield is really good. I don't care if the dividend was completely taxable. Would it make it less attractive? To some people, it would. But the dividend yields on those have been steady. And then in the article that was published, I think it was in the Wall Street Journal, they said that the distributions were down 32%. They weren't down to 32% in the midstream. That's not even close to being accurate. So that's another thing that you have to be really careful of. People really trust these big publications, and it's not the publication, it's the journalist that wrote the article. They don't do a lot of fact checking anymore. So you got to look really hard, look behind the scenes if you're going to invest in specific industries like that. So at any rate, and I'll have more to talk about that on future shows. And I also did want to mention too, I sent out a little blurb, a blast email to clients. And again, moving, haven't been able to get back to everybody as quickly as possible. It doesn't really matter. This is not something that's going to go away real quickly. But the 5G is a new technology. It's going to be used for cell phones. It's going to be used for a lot of different things, by the way. It's not just cell phone usage. And it's going to require that almost everybody that has a laptop that gets on the internet wirelessly, or has a cell phone, or has an iPad, or a tablet computer, it's almost going to guarantee you're going to have to replace that. In fact, it will guarantee over time that you will have to replace that. That's kind of a big boost, a big shot in the arm for the semiconductor industry and the semiconductor equipment manufacturers. It's been doing very well. As an industry, it's done incredibly well. It's volatile. It's really volatile. It's not one or two stocks that's going to dominate from that group. They're all going to benefit from it, some more than others. So the intelligent way, the prudent way to invest in that group, if you're looking for the potential for larger than average returns, there are several ETFs. You can call me, you can email me. I'll send you the same email I sent my clients last week, and it'll show you the what we're talking about, what I'm talking about. There are several exchange traded funds that are operating that differently, so you get better diversification that way. And you're going to cover almost the entire industry. And over the next 10 years, I think it's probably pretty solid. Right now, a lot of those stocks are not overvalued, something we'll be talking about this seminar. So when I say that in the future, you'll know what I'm referring to. When a stock is not overvalued, and oftentimes when people call in, if you want to call in, 216-901-0945, when they call in, they get upset because I'll talk about a stock, or they'll ask about a stock, and I know they're hopeful that I'm going to say, oh, yeah, this is a great stock. And then I look at the valuation, and I go, it might be a great company, but it's not a good time to buy the stock. Kind of like we were talking about earlier, Microsoft. You bought that, you had a 15-year period where your return was negative. 15 years. Why? Because it was overpriced. It's not good enough to invest in good, solid companies. You have to get them at a good price. You have to. Otherwise, your returns are going to stink. Really stink. And even when you're doing all the right things, by the way, your returns are going to stink from time to time. The market likes to make everybody look like a chump sooner or later. Those are the words of the famous Peter Lynch. And so you just have to try to do the right things over time. If there's a halfway decent amount of logic to what you're doing, and logic, not emotion. Emotions are horrible stock pickers. People that pick stocks based on emotions, the emotion is, I like it because it's been going up and I think it's going to keep going up. That's an emotional buy. I really like this because it's been going up a lot and I think it's going to keep going up. That's not a good way to buy a stock. You should look at the profit margins, look at the company, find out what the analysts think about it. That's easy to do today. It's free, actually. There are a lot of websites on there that give you the analyst estimates for free. And there's a super simple formula on how to do that. And like I said, I think I'm almost done. I will have that done by Sunday night. That's my deadline. So we'll be sending that out. And anybody that wants it, if you're listening and you want it, my clients are going to get it first. It's free. But it's basically a quick method for determining whether a stock is overpriced or not. We'll come right back to that after these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned. And we're back. If you have a phone call, question, and comment, 216-901-0945, 216-901-0945. You can reach me on my website, too, by going to bullingtoncapital.com. If you have any questions there, and feel free to call if you have a question or comment, something you'd like me to talk about on the radio. No problem. I'll try to do that. We start off this show talking about the master limited partnerships involved in oil and gas. At some point in time, a lot of those are probably going to just convert to regular old C corporations, the way a few of them already have. And that's fine. Those companies generate a ton of cash. They are regulated by government entities. That was one of the issues that had come up recently. Sent the share prices down probably more than they deserve to, which is typically what happens. I mean, that's another reason to have these seminars, because a lot of people think that stocks are logical, and that's because they're new. They're new to the stock market. Stocks are not logical. They're logical if you're looking out over the next 10 years. So 10 years from now, stocks that have grown their sales and profits that were selling at a reasonable price today are probably going to be selling a lot higher, and it's probably going to be relatively close to the level of sales increases that they've experienced. That's the long-term history of the stock market. Over anything less than 10 years, toss a quarter. I know people don't want to hear that. I know they want to hear that it's an even, steady return and that certain stocks just steady as you go. Well, it's not true. That is not true. That's why what I do is so important. And managing the risk, that's why it's so important to you. You need to know this. You need to know this for yourself, just to help yourself. And fortunately, unless I get hit by a bus, I'm not going away. And my seminars are free. You don't even have to pay. So you can go to Bullington Capital to sign up for that. And basic portfolio management skills. It doesn't get too much more complicated than that. In fact, the fixed income model I run, I laugh about it all the time. I compare it to the BND and AGG. From time to time, I'll be lagging it. From time to time, I'll be ahead of it. In the long run, we're ahead. Even after my expenses, we're ahead. So if you give it a long enough time period, simple logic tends to perform well. I'll give you an example. Let's take a look at a stock like Procter & Gamble. Or we start off talking about Microsoft. So let's use that one. Let's use Microsoft. Microsoft right now has a price to sales ratio of 7.5. Okay, that means it's selling for 7.5 times their annual revenue. Now, for a normal stock, that is really high. That's super high. For a company like Microsoft with the profit margins that they have, that's absolutely normal. That's absolutely normal. So when I'm talking about it in 2009, when it's at 18, not 98, it's at 18, or I'm sorry, it's 94. Nobody wants to talk about it. You know why? Because in January of 2000, it was $56 a share. So you go 9 years later and it's selling at $18. Nobody wants to talk about it. You're like, in fact, they'll start calling you names. They literally, people, and the reason they're calling you names, by the way, is because Microsoft did so well in the late 1990s when it was getting overvalued. And they bought that stuff and it had a big profit. And then they saw all that profit go away and turn really negative for an extremely long time. That's why they yell at you. And then you learn, don't bring that up. Don't remind them of how cheap it is, because they're going to be mad if they own it, And the people that aren't mad are buying more. So the people that are that sophisticated truly don't need me. So anyway, that's what it's like to be on my side. And just like these MLPs, I'm telling you, it's the most undervalued asset I own, and it keeps dropping. I'm not worried about it. I really am not worried about it. I think it's going to be fine. In fact, I'm going to probably allocate some more money to that, because even if that would be the greatest thing they could do, by the way, as far as I'm concerned, give up that tax-free yield. Who cares? If you're yielding 6%, it doesn't have to be tax-free. Not in this environment. So, convert. All you guys, convert. Become C corporations. Make it easy. Get rid of all that extra paperwork, too. So, that's a good thing. I still think it's going to be a good thing. I was right for the first 2 years, wrong for the last 3 years. But that's the way stocks go. That's just the way it works. And I get it. So, by the way, I didn't put a whole bunch of anybody's money in that. And that's another thing that you got to learn. Like we were talking about semiconductors. I think semiconductors are at a place when I look at their valuations, again, get to the seminar, I'm going to go through the valuation process 4 or 5 times in a row. It literally only takes about 2 minutes when you know what you're looking for and you know where to find it. Okay? So it only takes about 2 minutes to look up a stock and get a good idea of what it should normally be selling for, or actually even if you should be looking at that stock any further. Why would you spend hours looking at a stock only to find out that, this thing is overpriced? I'll tell you why. Because nobody showed you what I'm going to show you. I'm going to cut that learning curve down dramatically. And it is free. The seminar is free. Why am I doing that? Well, first of all, a lot of the people that come there that are new will come again, and they're gonna remember that stuff. And that's how I grow my business. After they become clients, they come back because there's a lot of stuff. Now, I'm showing you the very basics just on stocks. We do talk about a lot of other stuff, like how much risk you're taking in your portfolio. You can, if you send me a snapshot of your portfolio, or I send you a link, you can sign up. You can put in the positions, and we can see how much risk you're actually taking. We can see how much risk you're actually taking. Now that changes from time, because the market's changed. So you need to keep up with that. Once you've done that, it's not a once and done deal. Set it and forget it is not an option anymore. And at one point in time, it was kind of easy. You could do that. Now, it's just not an option. You have to set it and then manage it, and manage your risk and make adjustments. And your life changes. Your income needs are going to change over time. Hopefully, income needs go down as a percentage of your assets anyway. But and you may be taking more risk than you need to, or you might not be taking enough. You won't know unless you've got a really good tool to sit down and try to evaluate that. So again, feel free to drop me a line. I'll be glad to do that for you. Got a nice new office space. You can come in. I'm going to open up evening hours because I live so close by the new office that it's very easy for me to run back and forth. So and I like what I do. I mean, it's probably pretty obvious, but I really like this. This is fun. It's challenging. If you do it the right way. Now, it's kind of like riding a roller coaster, actually. I like roller coasters, too. I don't like them as much as I did when I was a kid. Because I never got motion sickness as a kid. Yeah, today, after like the 5th or 6th really intense roller coaster ride, I'm like, yeah, I think I'm done for the day. So, which is kind of the same thing with portfolios. If I'm looking at a portfolio, I wouldn't be as aggressive as I was 20 years ago. Why? Well, I'm 20 years older. I've been doing this for 20 years. Now, you younger people, you want to be really aggressive? No problem. I can show you how to be aggressive under control. That's a key. That's the key. Same thing with older people. Most people want to lock it away and not have to worry about risk or anything. And they're so afraid that they don't make any money. Or the money that they do make is, they're taking too much risk for it to try to make that extra money. And they don't realize it. I understand. It's not their fault. And my industry is largely to blame for a lot of that because they don't make it simple. They try to make it complex. The industry does that intentionally. It drives me nuts because it's so much harder to deal with. They don't understand what they're doing to the public, and they don't understand the torture they're putting them through, and that torture comes right back to the advisors that are dealing with that. You gotta make this simpler. Let's do a really quick example here. So Microsoft, over the past 12 months, Microsoft's revenue was up about 12%. That's a lot, by the way, for a company that's doing close to $100 billion a year. To go up 11%, that's a lot. That's like $11 billion of new business. New business. That's amazing that company can grow that fast. Now, they did something. I don't know what they did, but if you look at the profit margin, it wasn't very high last quarter. Average profit margins are extremely high. Average profit margins are extremely high. But what I'm really looking at is I want to look at the earnings over the past 12 months. They were $1.47, but when I look down and I see that the profit margin is minus 21%, I know they did some restructuring somewhere. That somewhere, I've been doing this long enough to know that, so I don't get upset about that. I look at the gross profit margin, 61%. That's before taxes. And because that doesn't change too much, all the adjustments to their earnings and whatnot typically comes after the gross profit margin is calculated. So that's a good thing to know. So gross profit margin, basically the profit that's left over after you pay your basic expenses. Wow. I can't believe it. That is the end of the show. I thought I had another 20 or 30 minutes. Holy cow. Anyway, thanks for listening. I'm here every Saturday morning from 11 to noon. Go to my website, bullingtoncapital.com. If you have any questions, have a good weekend. And everybody, good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.
Make your next vacation more than just a getaway from your day-to-day life. Make it one filled with personal renewal and where you form lifetime relationships with fellow conservatives. Hi, it's Mike Gallagher, hoping you'll join me on the 2018 Aloha Talkers Hawaii Cruise. It's a great time to discuss the future of our country while cruising in paradise amidst the legendary Hawaiian Islands. My fellow radio hosts Hugh Hewitt and Larry Elder will be part of this unforgettable week. And added to our lineup, our special guest, Mike Lindell from MyPillow. I promise this will be one of the best times you'll ever have. We'll cruise to the most beautiful islands in the world, see all the sights. Then every night we'll get together to discuss our country and exchange ideas about ways to chart a fresh course as we approach the midterm elections. That's not all. MyPillow will be giving each Aloha cabin a complimentary certificate for 2 premium MyPillows and cases. The 2018 Aloha Talkers Hawaiian Cruise, happening this August 11th through the 18th.
Book your cruise today at WHKRadio.com.
St. Jude continues to advance by increasing cure rates in childhood cancer. And donors are important to us because you get the feeling that you have a team behind you. When it comes to research and advancements, there are some things that only we can do because we have the resources and we have the focus. And so if St. Jude doesn't do it, who will?
St. Jude Children's Research Hospital. Finding cures, saving children. Learn more at stjude.org.
It only takes a minute to find out if you may have prediabetes, and you can do it at doihaveprediabetes.org. But you're probably not going to. Nope. I'm sure you've got a perfectly good excuse. Kids, work. I get it. You're busy. So what better time than now? Let's begin. Raise one finger if you're a man. Ladies, none yet. Oh, count in your head if you're driving. Now, 3 more fingers for everyone over 60, 2 over 50, 1 over 40. 1 more if you're not physically active. Another finger if anyone in your family has type 2 diabetes. Another if you've got high blood pressure. If you're overweight, raise another finger. 2 if you're very overweight. And 3 if you're really overweight. You've just taken the world's first audio prediabetes test. And if you're holding up 5 or more fingers, visit doihaveprediabetes.org or talk to your doctor. There's no excuse because prediabetes can be reversed.
Brought to you by the Ad Council and its pre-diabetes awareness partners.
You wanted to be a teacher when you were little, but as you grew up, things changed. Teaching just didn't seem like the best option anymore. So you decided to become something else.